Hey, everybody. Thanks a lot for joining us today for our webinar on Going Green, the Climate Change Opportunity in Banking. I'm Ron Shevlin, Director of Research at Cornerstone Advisors and Senior Contributor at Forbes, where I write the FinTech Snark Tank blog. I know there's a lot of people still joining right here at the top of the hour, so let's just give everybody another minute or so to get on, and then I will kick things off formally. We'll sort of give you a little preview. I'm just going to spend a few minutes sharing with you some of the highlights of some research that we recently published, and then kind of transition to a more of a panel discussion with Andre Cherney, the CEO and co-founder of Aspirations, Jason McDuff, VP at Green Penny, and Bragi Fijaldo, the Chief Marketing Officer at Maniga. So let's just give everybody another 30 to 60 seconds or so to jump in there, and then I'll give some directions on some of the logistics and so forth. I would ask you guys if you knew any jokes, but I'm not sure we want to start off that way. And I would do it, but none of mine are going to be politically correct or acceptable, so I'll bail out on that one.
You don't want to get canceled.
No, I don't want to get canceled.
There's no upside. No upside.
No. All right, I'm going to wait till, there we go. We're at 50, so I'm going to get going here. Thanks, everybody, for joining us. A couple of logistics here I want to share with you. We are definitely looking forward to getting your input and thoughts and comments on this. In the upper right-hand corner, I think in your screen should be a tab called Questions. At any time, please feel free to click on that. I'll be watching those questions, see if we can get the questions in. Otherwise, we've certainly left a lot of time towards the end of the hour, and actually not even the full hour. So please, if you've got a question, if it's for an individual person, please indicate who it's for, and I'll make sure that that question gets to that person. So again, thank you very much for joining this on Going Green, the Climate Change Opportunity in Banking. Before I actually kind of start, though, I want to share something that happened recently. After we published this report last week on the climate change opportunity in banking, I received a comment from somebody who kind of chastised me for taking political sides in this climate change debate or climate change issue. And this person kind of thought I shouldn't be taking political sides, especially in an environment where, as he put it, so many bankers don't give a hoot about climate change. He didn't actually use the word hoot, but it was another four-letter word that ended in the letter T. And my comment back to him was, I think you kind of either misunderstood or didn't read the report, because this isn't about politics. It isn't about the issue itself. It's really about the business opportunity here. And I think it might have been Jason who told me when I was chatting with him that, Jason, if it wasn't you who mentioned this, then I'm attributing a good comment to you anyway, who said, listen, there are plenty of grocery store owners who don't like bananas, but they still sell bananas because that's what the market wants. And that's what this webinar is about. And it's about the market opportunity, the business opportunity for serving consumers who are looking for better climate or more environmental friendly policies, procedures, and very importantly, products from their financial institutions. So I want to share with you just in a few minutes the highlights of some of the research. The report itself is available on Maniga's website. And Alicia, if you wouldn't mind going to the next slide, we surveyed a little over 3,000 U.S. consumers, adults. The sample was representative of the overall U.S. population in terms of age, gender, and race. And one of the first questions we asked is, what is the most important social challenge facing the United States today? And obviously there are a lot of them. And to a certain extent, the answers are fairly well spread out across a number of issues. But at the top, the most frequently cited by 23% of consumers was climate change. This is not to imply, however, that climate change isn't important to the other 77% of consumers. In fact, the next question we asked was, okay, across all of these channels, how to what extent do you consider them to be important? So Alicia, if you go to the next slide, what we ended up with was a segmentation of consumers. And so on the far left is the 23% who we labeled the climate conscious consumer. Those who said that climate change is the most important social challenge. But there's another third of consumers, 34% to be exact, that we labeled the climate aware. They did not say that climate change was the most important social challenge, but they said that climate change is very important. And 43% of consumers did not say climate change was the most important social challenge, nor did they even say it was a very important challenge. But what we're left here is a segmentation where more than half of consumers in the US say that at the least, climate change is a very important issue. Alicia, we go to the next slide, please. What's interesting as we compare these segments is that even though we've got 57% of consumers who either said climate change is the most important or at least a very important social issue, very few consumers are tracking their carbon footprint today. Among the climate conscious and climate aware, only about 1 out of 10, and little less than half of that percentage among the other consumers are tracking their carbon footprint. But their attitudes towards this is what really distinguishes and differentiates these segments. Anywhere between 3/4 and 80% of the carbon conscious and climate aware consumers said that the reason that they're not tracking their carbon footprint is because they don't know how. Only a half of the other consumers said that they were not tracking their carbon footprint because they didn't know how, but that's because a similar percentage said that they're not interested in tracking their carbon footprint. And only about 15% of the climate conscious and climate aware consumers are not tracking because they're not interested. So there's a strong degree of interest in tracking carbon footprint, but many consumers, even those who consider climate change to be an important or the most important challenge, just simply don't know how to do it. Alicia, go to the next slide, please. Now, many of them don't know how to do that, but across the board, across all segments, when we look at this from a generational perspective, there is a very strong level of interest, not in just tracking carbon footprint, but in using a carbon footprint tracker provided by their bank. Almost 3/4 of Gen Zers and about 7 out of 10 millennials. It goes down a little more than half of Gen Xers, and then really starts to trail off among baby boomers and seniors. But among younger consumers, who many of you I'm sure are looking to capture their businesses as they really represent the future of banking among Gen Zers and millennials, very strong interest in using a carbon footprint tracker provided by their bank. And that really cuts across all three segments. I want to emphasize, though, that their interest in tracking their carbon footprint and their interest in climate change regarding their bank is not just limited to a carbon footprint tracker. Alicia, if you go to the next slide, please. Many are actually looking for checking account or product features that embody climate change or environmental protection. So again, looking at the results from the segment perspective, we asked about a series of checking account features to gauge their interest. And about 7 out of 10 climate conscious and climate aware consumers say that they are interested in 3% cash back on purchases from companies with environmental friendly policies. Probably no surprise, anybody would want 3% back from any company. But as we look at some really more in-depth environmentally friendly policies or features from the product, about half of the climate conscious and climate aware consumers said that they are interested in a checking account that ensures that their deposits won't fund fossil fuel exploration or production. Roughly half say they're interested in debit cards made from renewable materials or upcycled plastics. A little less than half interested in actually getting carbon offset from their purchases using the account's debit card. A similar percentage looking for the option to plant a tree with every roundup. And then just a little less than half who are interested in a personal impact score to help them shop to match their values. These are product features. These are not just policies of the bank in terms of being carbon neutral. These are consumers who are looking to their financial institutions to not just only provide them with better climate impact information, but policies and product features that are built into the checking account itself. Now, interestingly, among the other consumers, it's not like those percentages are at zero. You've got about 1 out of 5 or so consumers in that other category who are interested in this. But clearly, the focus is on this 57% of consumers who are either climate conscious or climate aware. And Alicia, if you go to the next slide, which I do believe is the last slide before I get into the discussion here, I want to share with you sort of the perspective of what kind of business opportunity this actually represents. While the climate conscious consumer only represents about a quarter of all consumers, our estimate is that they account for a little over a third of deposits and a third of the loans that have been taken out over the past 2 years. The climate aware consumers are not as affluent as the climate conscious consumers. They represent a slightly disproportionately lower percentage of deposits and loans. And then other consumers represent about the equal percentage of deposits and a little bit less on the loans. So Alicia, if you can stop sharing the screen right now. I just wanted to do that as a backdrop to this discussion. And there we go. Excellent. Back to the. So I'd like to get into a discussion with our panelists here. And I want to start with Andre Cherny, who's the CEO, co-founder of Aspiration. Andre's resume looks very much like yours or mine. He has a bachelor's degree at Harvard, a law degree from Berkeley, was the senior speechwriter for Al Gore, spent 8 years as an intelligence officer in the Navy, and then decided that he'd become a fintech entrepreneur. So I'm sure many of you have the same qualifications as Andre does.
Or lack thereof.
Lack thereof. But
like my resume. It's
Andre, since I've met you, I have just been in awe of you, of what you do, and
kind of you.
I've got huge respect. And Aspirations been around for really about 8 years now, so it's not necessarily a brand new startup. And I actually wanted to start by asking you, what led you to conclude that there was a market for consumers who wanted environmentally friendly banking services?
I think that the market was smaller then than it is now, and I think that's part of why we're having this conversation today. But as you said, I had started my career now 25 years ago working for then Vice President Gore in the White House on the issue we were calling back then global warming, and trying unsuccessfully to get people to pay attention to that oncoming threat that was still at that time distant in terms of its impact, unlike what we're seeing in, unfortunately, the daily headlines today. Spent time as a financial fraud prosecutor, then did a number of other things, but really in 2012, 2013, myself, co-founder and others started thinking about what would be the opportunity to create a very different kind of financial institution. And looking at the companies across industries who were really able to bring products and services and a different approach to conscious consumers, to people who are thinking about ethics and environmental sustainability as they were making daily spending decisions, buying groceries, buying coffee, buying clothes, whatever it may be, and yet never had a financial institution built for them. And so we started Aspiration really with the idea of what would a institution look like if that was the approach from soup to nuts, in terms of products, in terms of technology, in terms of tools, features, services, and just generally the business model, and built up from there.
Yeah, Andre, you've never struck me as the tree-hugging, Birkenstock-wearing type of consumer, and I would probably somewhat cynically and sarcastically say that might be what comes to mind when you think of the climate-conscious consumer. But who are your customers? What do they like demographically, and what has surprised you about who's gravitated towards Aspiration?
Yeah, I think that image of the tree huggers, and I'm happy to hug any tree that comes around, but they're all very nice. But is is no longer the case. And I think your research and the scale of the numbers that you're showing clearly backs that up. When we look at our research internally and what we've seen in other places, is we're looking at it less in terms of awareness or consciousness, and more in terms of decisions. And what we see is that there is about a third of the public at large that is conscious consumers when it comes to their financial life, who want to and are primarily looking to those kinds of factors as they're deciding on where they want to bank. And frankly, that 1/3 is, in our research, equally as large as the 1/3 that are financial optimizers, that are the people who are looking for the best interest rate, looking for the best deal, looking to get their paycheck 2 days early, lowest fees, and so on. And yet a lot of competition for those financial optimizers, and nobody really before Aspiration had come along really thinking about how do you serve those conscious consumers. They are not just Birkenstock wearers or tree huggers. They are not, and it surprised a lot of people, just people who are living in Berkeley or Brooklyn or wherever else. When you take out that psychographic tilt around concern around climate issues and social conscience and building that into their financial life, it looks like the population at large. There's a age tilt, and your research shows this as well. People in their 20s and 30s are lean more into these concerns than people in their, let's say, 60s and 70s. But other than that, in terms of gender, in terms of income, looks like the population at large, the same distribution. Geographically, 94% of our customers live outside of Los Angeles, New York City, and the Bay Area. And so they, by and large, really cut across all other lines and are really united in this sense of real concern around the climate crisis. And that concern has, compared to where we were certainly in the late 1990s, working in the White House, or even in 2013, 2015, as we were starting Aspiration, has grown by leaps and bounds. All of the research that I've shown shows that we've moved from a place where there's concern to real behavioral change. You now see over 40% of Americans across the board saying that they are making decisions on which products to purchase, which businesses to spend their money with, on the basis of how that business treats people and the planet. The percentage of Americans who see climate change as not a threat, but above that see it as a major threat, is now 62% of Americans, and over 80% when it comes to people under 30. And so, as you said, whether or not banks give a hoot about this, there's a lot of people who certainly give a hoot about it, and people who don't see it as taking sides in a debate, people who don't see it as taking sides in a political issue any more than one takes sides in the issue of whether gravity is real or not. The jury has decided for a great majority of Americans, and certainly that's the case for people under 40, that this is real, this is happening, and they are not just waiting for government to take action or for the political process to play out or big corporations across the board to take action. They are thinking about, what can I do as an individual to make a positive impact?
Yeah, and I'll tell you, Andre, the research that we just did actually supports a lot of that, especially in terms of the percentage of consumers who do want to do business, and not just with banks, but across, especially things like food manufacturers, car manufacturers who want to see environmentally friendly policies from those type of companies. But I'm also interested to find out how you personalize or customize the product itself to be to serve consumers who are concerned with climate change or looking for environmentally friendly products.
Yeah, well, you listed 6 different kinds of attributes or services that people would be very interested in, and we offer all 6 of those at Aspiration, and we see people coming in for those products, but really they're coming in because of they're wanting to be part of Aspiration. They're wanting to be part of a company that is built with these values in mind. They're doing that more than they are solving for wanting to plant a tree or wanting to see their sustainability goal, all of which are important to them. But taking a step back and thinking about where fintech is, where financial services is, and you've led the way in this research, so telling you things that you know better than anybody out there. The promise of fintech to me is not that we're going to have better technology or lower fees or anything like that. That those are easily adoptable and incumbents can adapt to that. It's this idea that as opposed to 25 years ago, where you chose your bank based on what branch was closest to you, based on geography, now it's just as easy to open an account with Bank of America or Chase or Wells Fargo or many of the other local banks or Aspiration or Chime or any of now seemingly every day a new one popping up. And that means that we can be serving that community of people who, wherever they are geographically, share a set of concerns, share a set of values, and that's why they're coming to Aspiration. As you said, most people out there, even those who are really concerned with climate change, and especially maybe those people, they want to do something, but they don't know where to start. And what we're able to do at Aspiration is to create really an entire experience around helping people not just stop the negative impact that they're having from their deposits being held at financial institutions that are loaning a very large percentage of them out to oil and gas exploration pipelines and drilling, but ways in which they can make a positive impact with every dollar they spend, with every dollar they save. And that, more than any of the particular features, is why people are signing up for Aspiration.
Yeah, and what you're highlighting is really a broader trend in banking, which is the move towards affinity-based banking, whether it's climate change or not. This is certainly a trend. Andre, I've got one more question for you before I get the other folks involved here. Looking again at the customers that you have attracted at Aspiration, do they tend to switch banks from their other institutions, or are they opening up additional accounts? And do you have a sense for what percentage of your customer base considers Aspiration to be their primary versus a secondary account?
Yeah. One can usually see those things based on a different set of behaviors. And so what we see is a lot of our customers who are moving fully over to Aspiration on day one. But I'll also say again, our customers they tend not to be the financial optimizers. They tend not to be the people who are out there on NerdWallet or Bankrate.com looking for the best deal and likely to hop from institution to institution. There are people who are more of these conscious consumers generally, and therefore are less likely to spend their days thinking about their financial product. What that means coming in is that while there's some customers who get in with a cannonball and jump straight into the pool, there's a lot of customers who will get in on the steps and take one step and then another. What it also means, though, is once they're in the pool, we see very, very high rates of cross adoption. As you know, we announced plans to go public in a transaction coming up later this year, early next year, and so we've released a lot of this data. And what we see is 60% of our customers signing up for at least one other product or service in the first year alone, and so a very high rate of cross adoption once they're actually in the pool. What it also means, though, is that, as I said before, we have a pretty economically diverse set of customers, and so while other fintechs, other neobanks, other financial institutions may be able to do more of a single shot approach for people who are, let's say, debit card users and from an economic standpoint, very likely to be core debit card users. We have some people who are more debit card users with Aspiration. There's some people who are doing direct deposit who are using us more as maybe a lot of people use a checking account, a place where they're paying their bills out of, paying their credit card bill out of. Some people are using us more as a savings platform, and not moving their day-to-day banking, but moving a big chunk of their deposits because they don't want them to be used for funding fossil fuels. That means that we're able to offer a whole host of different kinds of financial products. We're now in the process or have launched our Aspiration Zero credit cards to some people and growing, taking people off that wait list. And so there's a lot of different ways in which we can serve customers across the board.
Excellent. Well, Andre, thanks. Hold on, hang out a little bit. I'm sure there's going to be a bunch of questions from the audience from you, but I want to get the other guys in on the discussion here, starting with Jason McDuff, VP at Green Penny. Jason's been there about a year and spent, I think, about 5 years before that at Wells Fargo, so he knows the banking world very well. And Jason, my assumption here is that there'll be a lot of folks on who maybe not be familiar with Green Penny or Decorah Bank. So if you wouldn't mind, just quickly give us the story of Green Penny and how it was created from Decorah Bank. But I want you to get to the details of what Green Penny's strategy is in the market.
You bet. Yeah, well, thank you for having us, Ron, and Cornerstone and Maniga. We really appreciate it. We're Green Penny. We've been around a little over a year. We are powered by Decorah Bank and Trust, which is a community bank in Northeast Iowa. 20 years ago, the father of our current CEO decided he wanted to live his life carbon neutrally. So he started tracking it, which few people were doing then. And he powers his farm in town with solar panels and geothermal heat and buys carbon offset tags for the local energy district. And that extends to how the bank operates. So we operate carbon neutrally. And then our community over the last 20 years has built one of the highest renewable energy adoption rates of any community per capita in the country. We think actually second only to Honolulu, Hawaii. And that happened because different people came together from different walks of life and decided to do something that's really difficult, which is to enable and accomplish a significant, meaningful adoption of renewable energy in a community. And of course, the bank financed a lot of that because this adoption, this transition is going to take capital, and banks are good at that, right? The Industrial Revolution was largely funded by commercial banks. And so as we go through this renewable energy transition, which is happening, the question for banks is going to be, how much do you want to be a part of that? And at Green Penny, we want to extend our experience in Decorah to more and more communities across the Midwest and through our deposit taking capabilities across the country.
So when we chatted, Jason, you talked a lot about solar lending as being a big part of what Green Penny is doing. And I'd like you to talk a little bit about that, but really focusing on sort of the economics of this. What's the opportunity out there, and why should other banks be paying attention to this?
Well, it's a great question. First of all, I mentioned that the transition to renewable energy is happening. So we don't have to talk about the debate about why it's happening anymore. It's already happening. Last year, 15% of the country's energy was powered from renewable sources. This year, it's projected that over half of all new power generation is going to come from renewable sources. Utilities have made commitments. Governments have made commitments. It's happening. So billions of dollars are going to flow into this space. And there aren't a lot of banks, particularly community and medium-sized banks, that are in the space yet. And we think they should be. And certainly we are. There are several products that are really important to consumers as they make this transition. Probably the most important purchase that most Americans are going to make in their life is their home, right? And there is a green mortgage product available already today at Fannie and Freddie that enables consumers to borrow up to 15% above the appraised value of their home, whether they refinance or purchase, and do a number of things to that home. They can put solar up, geothermal up. They can do energy efficiency work like weather stripping and energy efficient appliances, install an EV charger. And that's not only going to improve the value of their home, but it's also going to save them a meaningful amount of money every month. And think about that, again, from the economics of that for banks, right? We always talk about the refinancing booms happen when rates come down. Well, now you're talking about rates and the cost of the utilities coming down. So more and more mortgages will be in the money for refinancing. And again, this is a product that all banks that have a relationship with Fannie and Freddie can do today. Let's talk about electrical vehicles, which are happening, right? The second most important purchase for most folks. What are the economics there for folks? Well, more and more EVs are costing about the same amount of money as their internal combustion counterparts, but you don't have to put fuel in them. You don't have to do oil changes. You're going to do fewer steps or stops at the service station, and they're probably going to last longer. Evidence is continuing to emerge, but because of fewer movable parts, it stands to reason that they're going to last longer. So more money in the consumer's pocketbook, costs the same. Banks finance cars all day long. They're going to finance EVs all day long too. And finally, you mentioned solar lending, which we're particularly passionate about, which allows folks to not have to buy something that's not renewable. And let's just take a step back and not think about the carbon implications of that. Let's just talk about purchasing something that's renewable versus not renewable. So if you're purchasing something that's not renewable and your energy is not renewable, by definition, you're going to be paying that for the rest of your life, forever. And in the case of energy costs in the United States now, those are going to go up 2, 3, 4% a year forever. We have a utility around here that in one of our states just announced they're going to raise utility rates 9% next year. So they're going to go up versus renewable, which by definition is sustainable. It's replenishing itself. You're not going to have to go find it, dig it up, burn it, find more of it, dig it up, burn it in perpetuity. It's going to replenish itself. Yeah, there's some maintenance for the systems, but generally speaking, that's pretty small comparatively. So households are generally going to save a lot of money by going to what's called distributed solar, installing solar on their rooftops or on their properties. And they can use that money for other things in their lives. They can send kids to college. They can do lots of things. And in the case of low to moderate income folks, where energy costs sometimes can be 20 to 30% of your monthly bill, and it's an essential part of your monthly finances, renewable energy makes great sense to help free up capital that can be deployed in other ways. So our vision, our mission at Green Penny is to finance a sustainable tomorrow. And we think that banks should very much get in this space and help create that sustainable future we all need. And it makes economic sense.
Yeah, well, one point and then a question for you, Jason.
Sure.
The point is, the research actually bears out that about 1 out of 5 consumers or respondents to the survey said that it was very important to them that the bank that they get a loan from, now this wasn't just sort of the checking account view, but in terms of loan, that they wanted to get a loan from a bank that offered green loans and environmentally friendly loan products, even if they weren't getting a environmentally friendly loan product. So about 1 out of 5 said very important, about 40% said somewhat important. So that kind of supports your notion that consumers are aware of these things and looking to do business with those types of companies, especially in the banking world. The question I have for you, though, is why did Decora set up a separate business unit or spin-off to do this versus doing it internally?
Well, it's branding, right? It's an easier way to tell our story around what we do and enable us to feel local in more places without using the name of our community, right? Green Penny is, we want to feel like we're the local community bank in the renewable energy community that is similarly small to our geographic community, but more dispersed in the 5 states in which we lend in the Midwest. So we're going to show up and be leaders at Solar Energy Industry Association events, and you're going to see us at trade shows. And just like good community banks do, we are committed to the business, and we think we'll do quite well in this space, and committed to the cause. So we want to help be involved in creating renewable energy adoption, and the branding of Green Penny just enables us to tell that story more easily.
So is Green Penny's footprint the same as Decora's, or do you have a broader geographic footprint with Green Penny?
We focus on a much broader geographic space. So we lend in 5 states: Iowa, Minnesota, Wisconsin, Illinois, and now recently Missouri. And we take deposits anywhere in the nation. And folks can know that those deposits, just like your research said was important to some, will only be used to do renewable energy financing or carbon reduction financing in the case of our green mortgage I just described. None of it is going to go to fossil fuels. So if you're concerned about that, and you're concerned about the need for capital to enable this renewable energy adoption that we all need, Green Penny, that's what we're here to do.
Great. Jason, thanks. Stay put, because I know there's going to be a bunch of questions for you. I want to get Bragi into the conversation. Bragi Fijaldo, Chief Marketing Officer at Maniga, based in Iceland, and I think coming to us today from East Africa, Malawi. Is that am I correct, Bragi? I have to say, I think this is the first time I've been on a webinar where a panelist is coming in from Malawi. So thanks a lot for joining. And oddly enough, your picture looks clearer than Jason's does, and I think he's in Iowa. So the bandwidth is pretty good there.
At the moment, let's hope it holds.
Yeah, I hope so. Brage, I wanted to get your perspective from a European perspective, because I think it brings a unique perspective here. And there seems to be a growing trend in Europe of banks offering carbon footprint tracker services. What are you seeing in that? What's driving that development?
Well, I think, climate change has been a big topic in European banking for quite some time, but I think recently we've seen a massive shift in momentum kind of coinciding with the whole COVID crisis. And regulators are very vocal about plans to change and starting to pursue ways to shift capital towards more climate-friendly investments and so on. And I think, what we've seen in recent years is that, banks are reacting in multiple different ways. And I think one of the things that is interesting also to discuss is that those reactions are coming, not only because of consumer demand, they're also kind of reacting to regulatory changes, but mainly maybe anticipation of regulatory changes, access to finance, consumer sentiment. There's a lot of different reasons that are driving these actions, and there's been a lot of, and I know that's also happening in the US and worldwide, but there's been a lot of attention sort of in the past on managing the risk of climate change. Building climate change risk into investment and lending decisions, factoring in things like the effects of floods and storms and so on different regions, companies, and industries. And generally in Europe, I think, has kind of been sort of leading the way when it comes to really shifting assets and investments away from polluting companies and vulnerable areas over to sort of more sort of climate-friendly portfolios. But I think that what we've seen sort of in the recent 12 months is that the focus of European banks, and when I say European banks, I'm talking about the big banks, the incumbents, the market leaders in the space, is that the shift in focus sort of in my mind has been very much from risk to opportunity. And that's sort of similar to what your consumer study is revealing in the US. There is really a growing movement of carbon conscious consumers across Europe. Like Andre was sort of explaining, people that are really willing to make both purchase decision and life choices based on the impact of those decisions on the environment. And like you pointed out in the report, and Andre also mentioned, this is not a fringe movement, right? We've done research similar to yours in other parts of the world, and we're talking about 20 to 50% of consumers, depending on where you are and exactly how you define the segment. But not only that, I think, as you touched upon, Ron, I think the composition of the segment is extremely interesting, and it's quite similar in the US as you have found. On one hand, you have the younger people that are sort of more open to trying out different services, more open to switching providers than the average consumer. And on the other hand, you have sort of an affluent middle-aged population with more money to spend on values. And I think what's happened in Europe is that banks are increasingly recognizing the attractiveness of this growing segment. If you can serve the needs, that these people have, you're onto something. And that, as a result, banks in Europe have started to offer a much more sort of broader portfolio of green financing services. So not just investment products or savings products, but lending products like some of the ones that Jason was explaining, green mortgages, refurbishment, green refurbishment loans and car loans for eco-friendly cars or low emission and electric cars. And also services like carbon footprinting. And I think the reason carbon footprinting in particular is gaining traction is that when you look at this sort of the need of the carbon conscious consumers, there's really two things people are asking for. They want the tools to understand what their impact on the climate is and how they can do something about it, and then they want the tools to do something about it. And we live in a world where people spend a lot of time interacting with their brands and their companies on the mobile phone, and they have zero attention span. And nobody has the patience of sitting down, trying to remember how often they took the bus, how long they drive the car, what they ate for the last month to get an overview of their footprint. But there's an urgent need for people to be able to track that, and because that's really the starting point for acting. And banks are really in a unique position to make this service mainstream by basically building a carbon footprinting service based on your transaction data and provide that to you real time. And I think that's what companies or banks in Europe are realizing, is that if we can sort of attract consumers, carbon conscious consumers by providing services like these, we've built an excellent platform to to offer some of the green banking services to them in a place where they're motivated to convert those.
Yeah.
And just a couple of words on sort of the what we're sort of seeing in these markets. I mean, I think, and to give you guys a feel for what it's like in Europe and other places, it's like, I would guess that today we have maybe 5 to 10 banks in Europe that already are live with some sort of carbon footprinting service based on spending data. And we probably have another 10 that are about to come online. And this, when we started this, I thought, look, I come from the Nordics, I get it. Like, there's a lot of sort of carbon conscious people here, and I know people are going to want this. We developed this product, this white label product that we have, and we're sort of deploying with banks around the world because we knew we had demand in the Nordics. But I was really surprised to see how widespread this is. I mean, we are now in the process of deploying this with banks in Europe, but also in Asia Pacific, Southeast Asia, South America. I mean, this is it's not only that this sort of carbon conscious movement is no longer sort of tree huggers and people in Birkenstocks, it's global.
Yeah. Brage, I know that we're still kind of early in the evolution of this, but can you talk to the kind of adoption and utilization that some of the early adopters, and I mean adopters from the bank perspective, what are they seeing in terms of adoption and usage?
Yeah, I mean, like you said, it's still early days for carbon tracker solutions, and not too many case studies out there, although some of our customers will be coming out with some shortly. But what I can tell you is that, these solutions typically are seeing 20 to 40% adoption, sort of in line with what you would expect looking at your survey data. 20, 30% is not uncommon, what we hear reported and what we see in our installations. And generally, the solutions are receiving very positive customer feedback and very importantly, creating recurring engagement. So at least where we have been involved, and you have to also understand that the first carbon trackers like this, they came out maybe 1-2 years ago, most of them in the Nordics, and the early deployments were relatively basic. Simply just slapping a carbon value on the transaction without offering much insight, much ability to navigate and understand the footprint. And I think those early solutions were sort of had sort of limited recurring engagement. But the solutions we're deploying today focus a lot more on the sort of the real issues, which is really to make it easy and seamless to track and do something about the footprint. So it's not just giving you a CO2 number, but it's allowing you to really filter your carbon footprint by time and spending category to allow you to figure out where's my footprint coming from and how can I do something about it. It's really sort of educating about carbon footprint. What does a CO2 value mean to you? It's nobody, like if I tell you your monthly carbon footprint is 800 kilograms, it means nothing. But if I tell you, well, it's the equivalent of what 40 trees will absorb in a year, or it's the equivalent of driving your car so and so long, it gives you a feeling for what it is you're responsible for. And then there are services like, allowing people to benchmark, personalized advice on how you can improve your footprint, and potentially offering them options like offsetting and buying green financial services products. So I think the solutions that are coming to market today are driving much more recurring engagement than the early solutions in this space.
Yeah, but I mean, one of the things that we wrote in the report was recommending to especially mid-sized banks and credit unions that they consider rethinking their overall corporate strategy towards becoming, focusing the strategy itself around climate change, the climate conscious consumer. When you look at the banks that you've worked with in Europe, are they just simply, adding a carbon tracker to their existing mobile banking capabilities? Or are they really rethinking the overall strategy around of the bank itself to focus on climate change as a organizing principle for their strategy?
No, I would say it's very much the latter. And one of the things that we also sort of organizationally see in Europe is that by now most banks have established ESG departments, and they have a member of the executive team, or at least the senior management team, running that. And ESG is more and more becoming an embedded part of the strategy of the bank. Having said that, I mean, incumbent banks, they don't move as fast as guys like Andre and Jason, obviously. But I mean, if I look at some of the banks we're working with, sort of, launching a carbon tracker, allowing people to kind of understand and live with their footprint is really the first step of a journey, where you build a digital environment that is suited for promoting and converting green financial services online. And so it's really sort of, there's a whole business case behind the investment in building a carbon tracker that goes from, serving an urgent need in the market, providing solutions for how you can, become a more carbon conscious consumer, how you can consume more sustainably, how you can bank more sustainably, and by essentially offering and promoting green financial services, it becomes a business in and of itself. Some banks are looking at offsetting as a potential business model in this space. So there's a lot of different exploration in terms of where banks want to be taking this. But I think another point I'd like to add, which is something we see in Europe, and I don't know if you see it as much in the US, is that, while sort of, addressing the carbon consumer segment is a very important part of the motivation for building green products. It's also about access to finance. And we have several examples in both in the Nordics and other parts of Europe where banks have actually, they're offering sort of green mortgages on lower rates than normal mortgages, car loans for electric cars on lower interest rates, and they do this by issuing green bonds, where they get the bonds on more favorable terms, and so they're able to offer their customers better terms, and in some cases even build more profitable products, right? So I think that there's a lot of, you could say, forces at play that are driving banks more and more rapidly in this direction.
Excellent. Well, guys, I want to get to some of the audience questions because we have a whole bunch of them. And Andre, I'm going to go to you first. Interestingly enough, Bragi just mentioned ESG, and one of the questions from the audience states that in your investor presentation, you mentioned that 56% of Aspirations revenue comes from corporate ESG services. And can you elaborate a bit on what that term exactly refers to?
Sure. We talked about a little bit the start of Aspiration, really started thinking at our beginning around how do we take the ESG revolution out of just investments, which unfortunately very small percentage of Americans have as a meaningful part of their financial life, and bring it into, as we're talking about here today, people's day-to-day financial life, their checking account, their savings account, their debit card, and so on. And from there, what we saw was that those millions of transactions we were seeing was not only a lot of data where we could provide things like showing people their sustainability score, but millions of points of interaction where we could build essentially sustainability products for our customers on top of those interactions. Your debit card, your credit card being one of the few products that people actively pull out and use on a daily basis, multiple times a day for many people. And so we built things like giving people the ability to offset their carbon footprint or chunks of it, allowing people to plant a tree with every purchase, as you referenced in your presentation. And what we have seen in a way that is similar to what Bragi was talking about around financial institutions is that across the board, across all parts of our landscape, businesses are waking up every day to the need to meet the demand from their customers and their employees around what that business is going to do around climate change. And it's no longer just about investor pressure from the Larry Finks of the world or even government pressure, but this bottom-up demand from employees and customers. And so we've been able to take our sustainability tools that we've built originally for individual consumers and bring them to businesses to help them reduce, offset their carbon footprint, and do so in a way that really engages their customers and their employees in that process.
Great, thanks. Jason, question for you. One of the audience members asks, what regulations could the government impose to make banks operate in a more environmentally friendly way? And I actually would like to kind of expand on that question and just ask you, in general, how do you see the regulatory environment, pun intended, evolving regarding sustainable finance and climate change?
Well, it's an excellent question. And, as we compare and contrast here, what Bragi was talking about in Europe, where they've had relatively quick adoption with tens of banks in order to have things like ESG leaders and green products and enable their customers to empower their customers to act for themselves with cool tools like a tracker. The banking environment in the United States is way more fragmented. So we are one of a few very large countries that still has a very robust community bank system and medium-sized bank system. We have thousands of banks in this country, hundreds and hundreds of credit unions, which is not the case in most developed countries. So our challenge here is probably bigger in order to enable the banks or get the banks to do things that are going to help generate the kind of sustainable investments and products that we need. So we're probably a bit behind, is my guess. I'm not an expert in this and comparing against other countries, but my guess is. And one way to help with that, of course, would be where your questioner is going, which is regulations. Our regulators, I think, are still learning. We're wanting to be very transparent by talking about the ways in which we are developing these products and lending on them. Obviously, credit risk is relatively unproven here, so we're learning as we go, and we want to be super transparent about that. But I suspect as we all learn together, regulations will catch up, and we'll get more things like loss history to be able to inform other banks how they can do this in risk-prudent ways. I think another idea that I've heard others talk about that is not original to me, but one I'll share is CRA. We have a very robust Community Reinvestment Act in this country, and there are places in the CRA that banks get credit for if they have sustainable products and do things in sustainable ways. But there's probably more we could do. This idea of we do low to moderate income lending and put banks in low to moderate income areas. That's a big focus of CRA. Well, what if we deployed lending facilities to help low to moderate income folks get access to renewable energy, which from an economics perspective, as going back to the discussion earlier, is cheaper for them. And so they'll save money right away. Eventually, hopefully, they would even pay it off. So they wouldn't even have that expense, or maybe a de minimis expense over time. It's better for their health, to get a little bit outside of the economic arguments here, although health is expensive. In our country, a disproportionate number of folks live near pretty dirty fossil fuel generating utility plants. So being able to go to renewable energy is better for their health too, which has human and economic benefits, I suppose. So the CRA could catch up and do some things that would enable the banks to get credit for those things. And that's a meaningful part of our banking system in this country.
Jason, can you just expand on that a little bit? A question came in, and I think it's very related to this one about, can you discuss governmental financial incentives for banks for issuing green bonds, et cetera?
Well, right now, the biggest incentives we have, and of course, more may be coming, depending upon what happens with the infrastructure bill that's in Congress. But the government is certainly doing a lot to try to enable and build a renewable energy transition. The solar industry, a lot of that through tax incentives primarily. And there are a number of states, Illinois being one of them, that also has very robust state programs, because making the economics of this work, which is a huge driver of this. I mean, we started this conversation by talking about the business case of this. The business case of renewable energy transition is the primary driver of how we're going to make this work. I come from Iowa, right? Our company is in Iowa. 60% of Iowa's energy comes from renewable sources, mostly wind. 60%, number one in the country. And if anybody knows the politics of this state, which is very middle of the row, a lot of that did not happen because of climate change, right? That happened because the economics work. And one of the main reasons the economics work so well is the incentives that have been sponsored by the federal government, and until recently, our state also had some incentives as well. Right now, there's a 26% tax credit for income tax credit for installing solar. And that's through the next couple of years. The current infrastructure bill would raise that and extend it, is what we're hearing. So that's a major feature of what's going to enable this transition. And there are other examples for other aspects of renewable energy too, like wind and geothermal, that are also similarly suited with tax credits.
Awesome, thanks. So I think we got time for one last question, and Andre, I'm going to direct it over to you. One of the attendees asks, how can the model of Alipay Ant Forest rewarding climate-friendly lifestyle choices with points that can be converted into tree planting, and her examples are 500 million users, 100 million real trees planted, 400,000 job opportunities. How can that be adopted by US and European banks or in financial services companies in general?
Well, I would say to a certain extent, we've done it. We launched something called Plant Your Change last year that allows our customers to plant a tree with every purchase they make by rounding up that purchase to the nearest dollar. And so you buy something for $4.75 and we'll round it up to $5. Whatever the size of that roundup is, we'll plant a tree. We have now across that initiative and the other things our company has been doing, Aspiration Community has planted over 35 million trees over the past year. So catching up to Alipay's 100 million, we're likely to plant over 100 million just this coming year alone. And
how do you do that?
Now planting more trees.
Who do you work with to do that, Andre?
Work with a number of NGOs on the ground. So we're planting in Mozambique, Madagascar, Kenya, Brazil, Honduras, primarily. These are NGOs that have been doing this for many, many years. And so they're the ones doing this, of course, on a daily basis. But, we're planting more trees than there are in Central Park every 12 hours or so. So really having an enormous impact. And I think the important thing that I always say about this is it's not Aspiration doing it, it's our customers who are doing it, right? It's their spare change that they're doing, 25 cents at a time, nickel at a time, 50 cents at a time. As they're going about their day, buying that cup of coffee, buying a newspaper. And the important thing is that it's automated for them, right? There's even with everything we're talking about, a relatively small number of people who are going to go and separately go offset their carbon footprint, separately go to Arbor Day Foundation and pay $1 donation per tree. But if you can build it into people's lives, and those are the kind of sustainability tools I'm talking about that don't necessarily have anything to do with traditional definitions of a financial product, but are ones that ride on top of the interactions we're already seeing as that person does buy that cup of coffee or that newspaper. And so that's allowed us to have really enormous impact. And so we're not at Alipay's levels in many ways, but we're trying to catch up.
And you're one relatively small company compared to Alipay and catching up to them. So we are just about at the top of the hour. Yep.
Ron, can I address Jason's comment from before on the US market?
Of course. Maybe not. Now we may have just lost Bragi as he's frozen there.
I'm back. Good. I just wanted to address what Jason was saying about the fragmentation of the US market. And I just want to point out that it is harder, and I think the US is behind. But I would argue that the fintech companies have a role to play here to make it easier for smaller institutions to get started on this journey. And I would also point out to some of the smaller banks in the audience that it isn't expensive or difficult to get started, for example, with a carbon tracker, with carbon offsetting, because there are parties offering these services white label. It's neither costly nor has to take a long time. And I think beyond that, when it comes to green products and other green financial services, I think the fintech community has a role to play to enable the U.S. market to catch up faster. And I would say, even though that you're not as far in this in Europe, on the flip side, I think a lot of these smaller community banks have an opportunity to stand out and differentiate by being a first mover in their region.
We totally agree with that. Everything you just said. We are so dependent upon vendors. In order for us to compete with large banks, it means we can't bring things in-house that other larger banks can. So we are totally dependent upon fintechs and our vendors to enable us to move. We are an early mover, and so we are trying to prove the way for others to follow suit by doing what we're doing. We have a carbon tracker. It's not the best, admittedly. It's I think some of the tools that are out there that I've seen are much better, and we're anxious to explore those. So I'm glad you said that, Bragi, because we totally agree.
Awesome. Well, I'm going to give you the last word there, Jason, and thank everybody for spending an hour with us to discuss the opportunity for climate change in banking. I want to thank the panelists, Andre Cherney from Aspirations, Jason McDuff from Greenpenny, and Bragi Fajaldul from Maniga, coming to us from Malawi again. Excellent. Thank you, everybody, and hope you got a lot of value out of that, and we look to talk to you again soon at the next webinar. Thank you.
Very good. Thanks, Ron.
Thank
Thanks,
you.
everyone.
Bye.
Thank you.